but I know it's a word out of the
It
curve there.
is. It is. Nate, one stock I was gonna bring up today. Over the weekend, I was spending some time saying, so I've got my retirement account that I threw it all in Oklo.
Hmm.
That was
I'm
awesome.
going to
It's all
mention
in,
Oklo today.
oh, nice. It's all in Meta right now. But I was thinking over the weekend, I got to find a new stock that I can really just throw the whole thing in and see what happens. And my new stock that I was going to tell you guys about today, and it still is, but I really like Robinhood right now. And I should have, I don't know why it took me about 2 months ago, I decided I really liked Robinhood and did nothing with that information. But now I'm like, wow, they've got some really cool stuff going on. And
Yeah.
now I'm wishing I talked about it or thought about it on Friday. Stock's up 6, 7% today so far.
Yeah, I think it's up like 200% almost since the lows there in April
Yeah.
7th or whatever that low was. Unbelievable move.
The reason I really like it, and I used to have my brokerage in Robinhood. I took it out after the whole GameStop thing where they locked up all my money and didn't let me trade, and then I was getting horrible fills as well with my options. So I basically banished
Same.
Robinhood from
Same.
existence. Um, but I really like what they're doing now as a company. They're going much beyond just standard brokerage. I mean, they're doing
Hmm.
basically a whole bank. Like they're coming to compete for JP Morgan, Mastercard, lenders, all sorts of stuff. And I think my thinking is that they do have the whole 40 and under crowd basically already working with them.
Yeah, I think that they are trying to basically do what we would call LTV, lifetime value, where they get all those people's money in and then they become not just their option trader, but their actual stock holdings, their cash account, their mortgage.
Hmm.
They do everything with that money. And I think it's a really good strategy. And, they started on this technology path of just being better at technology in a world where that's obviously going to drive a lot of opportunity. They were really early on the crypto, letting people invest directly in crypto, and then now they're doing the prediction markets, which are gaining. I mean, we saw that report from just that one media outlet. What would they open up? 180,000 funded accounts or something.
Yeah,
So
it's pretty
they're
cool. And Nate, I don't know if you've seen, I'm a gold guy. They got the gold card now. Have you seen that?
yeah, I've seen it.
Where if you get ten Robinhood referrals, you get a 14 karat solid gold credit card.
Yeah,
Might have to drop that referral link in Telegram.
yeah. Dave, I know for some reason, I think it's Dave. It's because like I upgraded to a premium account so I could send bigger messages and stuff, and they somehow decided that was a good reason to start scamming ads in my account. I do got to open a new. I just got to move it over at some point.
Nate, you've been saying that for months.
I know. Well, actually, like a year,
Yeah.
but I haven't done anything with it. So you know. All right. Well, how's everyone doing? Happy Monday. Uh, by the way, I think Deanna's going to open up the chat. If you guys want to chat to everyone, you can do that. You just got to change the little bubble there above so that it says everyone right above where you're typing as soon as that's open. And you can chat to everyone if you want. Obviously, we just ask that you're respectful, kind, all that sort of stuff. But other than that, feel free to jump in as soon as that chat is open. It's just a little blue box that says two above it, and it's defaulted to hosts and panelists. And you want to click that, and then click everyone, and then you should be able to chat to everyone. As long as got that flipped. Dion, I don't think it's set yet. If you want to flip that, Bob and Jay say not yet. I don't know why we can't do it, Graham. I guess we're not important enough to be able
Yeah.
to
You don't
change the
have the
settings.
power. You don't have the power. And as a reminder, everyone, this is a short trading week. We've got the 4th of July on Friday. Thursday's a half day. So just make sure you remember that this week. There won't be any trades to be set on Friday unless you're trading crypto, then be my guest.
Here, I'll stop
Stock
sharing my
market.
screen and message Deanna real quick. Just
We have some questions here about the 60-minute income strategy. We're still
oh yeah,
within
are
the
you
range right now.
okay?
It dipped below for a second, came back in. So we're still waiting for that 5-minute candle to close above or below. Looking like below right now, but it's got to happen before 10:30.
All right, yeah, you're on the clock here with a couple more bars here. All right. Well, hope everyone's doing well. I'm having a great Monday because my active trading account hit all-time highs this morning on the open, which is always good. Always love when the active account gets new highs and is moving up. So good there. I'm going to talk about Oklo today a little bit. It's one of my stocks, one of the key levels that I have. But let's talk about what we've got on the agenda here. We've got the biggest weekend news that might filter through the market, quick market outlook for you, sector strengths, some weekly levels to watch, our top ranked stocks. So you've got weekly levels on a couple tickers and our top ranked stocks, and then our lesson for the week. Probably one of the most common and one of the most important questions I get. We're going to cover today as well. So weekend news. I think the biggest news here is that things in the Middle East seem to be cooling down a bit. We had obviously the U.S. dip their toe in the water, get involved, but kind of immediately pull back and said, "Hey, that was a one-time involvement. What we really want is a ceasefire." Seemingly trying to hold Israel and Iran accountable for maintaining that. And so if that continues, then I think it's a decent catalyst for things to move higher. Also looks like Canada and the U.S. Might be moving closer to a firmer trade deal. And then, of course, we got the big, beautiful bill passing, which is going to be interesting to see how that impacts. I think we'll definitely get some short to medium term lift just because it is a big spending bill. And almost every time we get spending, we get markets with more equity in them. And so those are the things floating around right now. I think all three of those are shorter term, to maybe medium term impacts. And frankly, all three of them should be net positive, assuming we get the follow through expected. Here's our market outlook. This is from the weekly chart before open today, which we're up a little bit higher. The SPY is now at 616. This is at 614.91, the weekly close. And I don't know about you guys, but it was looking rough for a while there. However, we did get really good follow through, and we are now at all-time highs in the S&P on June 30th. Just like we talked about, predicted, we're incredibly bullish, even at the 520 and 530 level. And so hopefully, if you guys are an opening playbook, you got to take full advantage of this very bullish market that I think we, did a good job of being aggressive on and looking for opportunities while everyone else was kind of in wait and see mode. And so hopefully good bonus for anyone in opening playbook taking advantage of this monster rip to all-time highs. Of course, the question is, what happens next? By the way, VIX down as well, popped a little bit, about 1720 today, was all the way down to 1650. And so when I posted this, I said, call me crazy, but I'm still short VIX here, just because the idea that the market was on the precipice of getting to all-time highs at that 600, 602 level, and the VIX had spiked up to the 21, 22 level, it seemed out of place. And so I kept saying, hey, we're floating up here in the 20s, which is not super high on the VIX, but it's too high for the market to be at all-time highs. And so if you traded that, VIX did go down about 12 to 15% from those low 20s down into the 16 range. And if you got, if you really peaked it and got the top, you were down about 20%. So a nice opportunity there on VIX. Okay, Deanna said that she opened that up, guys. So if you want to change your chat, you should be able to do that now with that little blue box there that says to host and panelist as the default. Click the little down arrow and change that to everyone. And then you should be able to chat to everyone. By the way, interesting thing here, insiders are still not buying. So we're seeing, this has been one of the lowest trends consistently for insiders buying that we've seen in quite some time. We go back to COVID when we got that really big flush, and the insiders really stepped in pretty much immediately and started buying a lot of their own stocks. Now, when I say insiders, I'm talking about corporate execs. I'm talking about the CFOs, CEOs, those sort of people. And it's really interesting to see that even as the market has been in turmoil and a lot of the retail groups started buying the dip back in April and into May, the insiders have stayed really quiet here, and we haven't seen that. So it's interesting to see if they're just going to stay and wait for the next run here. We really haven't seen a lot of that pick up. Now, interestingly, while insiders have been very, very quiet, the dark pools have gotten outrageously bullish. This is the most bullish flow I've ever seen on the dark pool side. This is orders of over 1,000 contracts, so 1,000 contracts and more. We're seeing the highest percentage that I've ever noticed here, with 65,000 call flows on the bullish side and only 4,700 on the put side. That's from last week. So last week, those big blocked, kind of private orders behind the scenes buying up were 93% bullish. Pretty wild there. So again, while insiders, while the CFOs, CEOs, COOs don't seem to be very bullish based on the buy to sell, the dark pools seem to be massively bullish with the last week. And if I showed you some of them, I mean, some of them are crazy. NVIDIA had a total of 53 million in call options last week on just the dark pool buying side. So $53 million flooding into NVIDIA just on the call side. Pretty massive orders there. And I think it's because the anticipation here is whether or not you're long-term bullish, the market seems to be aggressively bullish for the short term. And usually when you spike through all-time highs, you'll get a little bit of fall through. And I think that's what people are expecting. And I don't think, I mentioned this before, I don't think that the hedge funds can stay on the sidelines too long when the market's ripping. When the market is up 12 or 14% year to date, which it will be, if we fall through with some highs here, you can't keep your clients on 4%, or 3.5% cash money and just saying, hey, we're doing a great job, for your big money. You kind of have to get yourself involved in the market. So I think it's going to force their hand if we continue to go higher here. As Graham's been talking about, not only are we pushing all-time highs, but July is a heater. Historically, this is from the last 20 years. 80% of the time, July is a positive month. So it's the highest of any of the months. And then, if you look at the actual performance-wise, it's a big winner here consistently. So we expect, and we've kind of predicted this for a while, that July should add fuel to the fire of a very bullish market. I'm certainly optimistic. I'm going to be, careful. I'm not just taking directional trades. I don't want to, blow up my gains from what I've done in the last month, which has been really great. But at the same time, I want to be aggressive and make hay while the sun is shining. And July, typically the sun is shining. As we look at sectors year to date, really interesting. I shared on Telegram last week that if you take the kind of like the April low or mid-April, XLK, the tech sector, is up 44%, the entire tech sector since mid-April, which is just an unbelievable number for that sector to be up. However, because the tech sector usually takes bigger hits on the flushes and then has to rebound, like for example, MAGS that I always talk about is not even at all-time highs right now because the flush was so big. When you blend it in year to date, XLK is actually, kind of third or fourth here. And we've got XLI and XLC leading the pack year to date. Now, XLI is leading the pack in large part because nuclear has gotten some massive pushes to the upside. We've seen some of those stocks really, really rip. XLC, we've seen outperform. I mean, Meta, Google have really done well. T-Mobile was ripping for a while, but sold back off. A couple other there that just maintained during that April, actually even going back to March, just handled the heat a little bit better and have rebounded. And then we've got financials, which I really like trading, tend to be very stable. We've got XLK, of course, XLU. And then at the very, very bottom, we've got the XLY, which is discretionary. Again, took some monster hits there. I mean, you can see how bad the discretionary hit was here. Almost as bad as tech, but just not the horsepower to get back up to the upside. If we go just the last month, go Graham.
I was going to say, speaking of financials, I know you just mentioned it. Visa's looking really good right now if it gets to close above the 50-day moving average.
Yeah,
just that's fun fact.
Some of those stocks, Visa, MasterCard, BlackRock, I mean, just really, Morgan Stanley, just really unbelievable how much they've ripped. Because if you guys remember, actually, you can probably see it here. Financials was recovering and then took this other really big drop a little bit later in April, and it looked like, oh, geez, financials pretty soft. and then they've just ripped back as well. Here's the last 30 days where you can see tech really starting to dominate again, up 9% in the last 30 days. You can see communications there as well. And then everything else kind of falling more middle of the pack in the last 30 days. But if we look at what the future pacing looks like, it's all pretty green. Graham has mentioned infotech quite a bit, financials as well. So, two of the hottest sectors look to continue to be hot. Real estate, very hot as well, but I don't think I trust real estate enough to buy into the 2.7% number there. I mean, you could trade it, especially because it did have a nice little dip. So it might be a reversion to the mean kind of trade in a July. If you like it, I'm probably going to avoid that and focus more on XLI, XLF, XLK, and of course some XLC because I think it's a great sector. I like it. All right, let's talk about some weekly levels. Okay, so we've got Oklo. Ripped all the way up to $74. Unbelievable run we had on Oklo, and then actually came back below our previous peak here at 60. So I think this $60 level right here is going to be a key level for Oklo. If we get to move back above it, I think you could trade this pretty aggressively for all-time highs. The way that I would trade it for all-time highs is with a risk-defined kind of jump trade setup, where, in other words, I'm not taking a trade that, if it falters and drops back down to 50 or 45, that I'm holding the stock and taking the heat. I'm just putting a 30-cent debit spread on there, and if it rips, I'm going to make 500%. And if it falls back below and fails to make those all-time highs, then I'm going to take a risk-defined loss of whatever I put into a trade like that. So these are the kind of trades that I like, really taking advantage of risk reward versus buying and holding. You could hold Oklo. I think it's a great stock to hold. But if it drops down to $45, that just has to be expected and part of that for you. If you really want to trade it with risk defined, risk reward, I would trade, if it closes above $60, something like a $69, $70 spread, where you're probably going to make 500% if it hits that by the end of the month. So that's the kind of trade I would look for on Oklo. We've got, speaking of financial stocks, BAC, that's Bank of America. I mean, look at this chart of Bank of America. This is that does not look like a financial chart there. Unbelievable move here on Bank of America. Now, what most people would say is, okay, now it's overextended, so you shouldn't trade Bank of America to new highs. I mean, look how overextended it was. I'm not really a big believer in overextended. I mean, sure, that can happen. And if July ends up faltering in general, we could see a lot of stocks that look like this come back. But I actually think we got a little bit of a rest here. And if you see what the last run pretty much straight up did, and you just match that, we've got a lot more potential on Bank of America. So I'm someone who doesn't mind trading stocks that move to all-time highs. In fact, if you just run the numbers and all you do is trade stocks that go to all-time highs, you'll be in pretty good shape. So I like Bank of America here, and I think if it breaks above 48, which is our key level, it's a pretty decent opportunity there. We've got Amazon here. Amazon already broke through this 220 level, and so this 233, not a huge level, by the way, just kind of a midpoint, but I think it's a nice little level that you could trade Amazon into. You could trade, 2 weeks out or at the end of July and go for an opportunity that targets that 233 zone. Amazon, I think, is a really great stock that just kind of got behind the eight ball here a little bit and didn't quite make the jump that some of the other Mag 7 mega caps could have and did. And so I think it's catching up, and I actually quite like where Amazon's at in its current shape. We've got ANET, of course. We can't have Opening Playbook without talking about ANET. I actually, once again, really like ANET. I gave you a trade on Friday. It's a nice, clean $100 level. I haven't looked at it this morning because this is from Friday's close. Is ANET up or down today,
Up
Greg?
another 2.5% today.
Okay, so we've already ripped past the $100 level then. I love it. I think it's got a clean slate above this 100 level, and you could trade this, as far as I'm concerned, any level of aggression. You could trade this week's expiration for 105. You could trade next week's expiration for 110, go for a moonshot. You could trade 3 months expiration and go for all-time highs at 130. I mean, a whole bunch of different ways to skin that cat, in my opinion, but I really like ANET, and I think this $100 level is a clean break. Lots of room here to run for ANET, in my opinion. Fun one here, Marvel, just to throw a little bit of a corkscrew at you here on a stock that we wouldn't usually talk about, but hit my list here. The reason it hit my list is because it has seasonality, but more importantly, has some institutional flow right now. I'm not a big institutional flow guy, but I like it as a confirmation. And if it breaks through $80, you can just see, wide open space here for Marvel if you want to trade it over the next few months. So just an interesting one there if you like Marvel, because it's starting to build a base here, and if it cracks through this 80 zone, which I think is a solid zone there, just so much open space. So quite a few stocks there at those weekly levels that I like. I like trading kind of momentum breakouts, and there's a couple for you there. Top ranked stocks for today. Obviously, there's not all the top ranked stock, just a couple that I pulled. We've got NVIDIA, we've got AVGO, Infotech here. By the way, I think AVGO, if you like trading the heat, AVGO should be a good one. We've got IBM, which is kind of more of the boring stocks. Now, I've been liking these boring tech stocks. I think they're kind of giving us a nice balance of upside and stability. IBM, Cisco, Dell. I think those have been some really nice stocks there as well. Like I mentioned, Bank of America, really nice financial stock, trying to head to all-time highs. And then if you want a ripper, we've got RCL. I mean, RCL, if you've seen that chart, has been a monster and still fitting all of the criteria: trend, momentum, seasonality, and has some institutional flow as well there. So I'll just pop these in the chat for anyone who wants to keep an eye on them. And in terms of how you want to trade these, I mean, you guys probably know what I'm going to say. I really like using the income machine style on some of these, where you have momentum, you can trade with the direction of the trend and the momentum there, and then be a little more protective in terms of how you want to trade it versus being having to get the timing and the direction right. So that's kind of my preference right now. But I think with a lot of these stocks, especially stocks like ANET, I think you could be pretty aggressive and trade directionally. All right, let's go ahead and talk about the lesson of the week. Now, I am sure of the 400 plus people in the room today, many of you have been some of the ones who have asked me this question, because it's probably the most common question I get. Why don't I use stop losses, or is there a stop loss, or something in between? In fact, if you want, you can just give me a yes in the chat if you're someone who's asked this question, because I know I've probably gotten this question more times than virtually any question that I get, which I get a lot of questions, but this is probably the number one. Now, for me, I like how I said two instead of three. Good typo there, Nate. Three main reasons why I don't like stop losses. Number one, it's too easy to lose. It's basically giving yourself or giving the market an easy way to take you out of a trade, which is something that I really don't like doing. Number two, I want to use time to my advantage. And if you use a stop loss, what you're doing is you're basically taking time out of the equation. Because as soon as the stop loss is hit, you take any, if your expiration date is June 30th and you get taken out of the trade June 10th, now you've taken 20 days out of the trade that I usually like to use to my advantage. And the number three is the risk reward changes. And I think this is the part that most people don't really understand about evaluating a trade. I think most people tend to look at a trade like, hey, it no longer has a good chance of winning, so I'm going to get out, versus understanding that the risk reward changes in real time as the trade progresses. And I like to think of it not whether the trade is, now has a high probability of winning, but under the new risk reward circumstances, is it still a valuable trade? And so what I'm going to do is I'm going to walk you through this risk reward, because I think this is the one that people get the most tripped up on, and it's kind of, might be a little bit harder to understand, but I'm going to give you hopefully a walkthrough that makes sense. I'd love your participation in the chat as always as I go through this. Hopefully you get a little bit of a light bulb moment here, which is always my goal in the opening playbook, to kind of do a training and give you one of those light bulb moments for how to evaluate trades in real terms, not theoretical terms, not whether it's going to win or lose, but kind of in real valuation terms. So let's imagine that you take a trade here and go through a situation based on the way that I would typically trade and how that risk reward works. All right. So we have a line in the sand right here on our imaginary trade. Okay. So we're imagining the stock is, trading at 210, and we put a line in the sand here at 205 and 200. What does the line in the sand mean? What it means is that you need the price to finish above this sold call to be a winner. Now, when does it need to finish above that line in the sand? At the expiration date. So let's imagine that we have an expiration date right here. That's July 11th. Okay. Let's say that because this is a $5 spread, 200 and 205, that we paid $4 for the spread. Okay. So we have $400 of risk per contract, which means we have $1 of potential reward. So let me ask, before I move on, be honest, because we can take a minute here and clarify. It's very important. Does everyone understand what's actually happening in this trade? You can tell me no if you don't understand, and I'll try to walk through it. I just want to make sure that we understand the preface of the trade, or else nothing else is going to make sense here. Okay, we've got a few no's, which is totally fine. Totally fine. Okay, let's walk through it and just make sure that we understand. So what we did is we took a trade right here and we bought a 200 call and we sold a 205 call. And what we're looking for whenever we do a debit spread like this, below these below the market, actually anytime you do it, but in this case below the market, we are looking for the trade to close above the sold call, what I call the line in the sand, above that level for our max profit. How do we get the max profit? It is the width of the spread. Okay, so when you buy a $200 call and you sell a $205 call, the max that can be worth is $5. That's the width of the spread. And to determine whether you make $5, all you need to answer is whether or not the stock finishes, whether it expires on your expiration date above that level. That's the entire baseline of what we call a debit spread. It hits the max value if it expires above that level. Now, if you paid $4 for a $5 spread and it can be worth $5, you automatically know based on paying $4 that your potential is going to be $100. Paid $4, the most it can be worth is $5. Therefore, you can make an extra $100 on the trade. Okay, so that's a 25% ROI if you win that trade. Okay, you paid $4, has the potential to be worth $5. That means it's a 25% ROI on the position if you win. All right. Now, let's run through the scenario of the trade and kind of walk through what I think most people often get wrong, which is evaluating the trade in real time as the risk reward changes. All right. So let's say day one, the trade goes up $10, right? Well, what happens in real time is that now your risk is no longer 400 and your potential is no longer 90. Your risk is actually 410 and your potential is 90. Because as the trade went up $10, your what you would call equity or liquidity, your net liquidity on the trade goes up with it. And so you're now in real time risking $410 to make the remaining portion of the trade. If it goes up, or if it goes down, $50, your $90 is now $140. Your risk is now $360. If it goes down $70 more, now your potential is $210 and your risk is $290. And let's say it goes down even more and it crosses below, which actually happened to us on Amazon on one of our trades. I can share that one in a moment. Now it went down $110 more on day 4, and your risk is $180, and your potential is $320. So I want to pause here for a moment because I think this is what people get wrong. They look at a trade that's gone down. It looks ugly. I should just exit the trade. And what they think is it looks like a loser and it's not worth holding on to make not $100. Okay. Has anyone ever thought that a trade goes down? You paid, $400 for it in this example, and now it's down. It looks like it's going to be a loser, and you think to yourself, this looks like an ugly trade. It's not worth holding on to this trade to make $100. The problem with that is that if you look at this in real time, you're no longer talking about making $100. Your potential is now $320 on the trade. Why? Well, because you risk 400, it's down a total of, $220 right now. And if it's a winner, it will realize $500 in gross value, which means that your real potential here is $320. Guys, it doesn't matter where the trade started. That has nothing to do with anything, to be honest, once you're in a trade. It has to do with the current reality of the trade. And the current reality of the trade is that if it finishes above $205 in our example here, your potential profit is actually $320. And so for me, this is where the rubber meets the road, and why people ask, why don't you use a stop loss? Why do you let the trade run? It's because as this risk reward changes, I like using time to my advantage. And assuming I'm trading a good stock, I think time is to my advantage. I think the more likely scenario here is that using time to my advantage, a good stock like Amazon, Microsoft, Google that are in trends right now are actually going to have a higher likelihood to finish higher. And while I would not risk $400 to make 100 in this scenario, okay, I wouldn't risk 400 to make 100 here. I'm not risking 400. I'm risking 180 to make 320 on my open trade. That's what's happening here. I am risking 180 to make 320. And at that risk reward, I actually still think it's a valid position. Okay, let's keep going through the scenario. Russ said, I don't see your logic. As long as I'm in the trade, I still risk 400. Russ, that's correct. But on July 1st here, 4 days into the trade, you're no longer risking 400. You don't have 400 to risk. You have 180 to risk at this current moment. All you have, Russ, in this current moment is $180 to risk. Your trade is only worth 180. And if it closes above here on July 11th, it's worth 500. So what you started the trade with has nothing to do with anything. You now have $180 left on the trade to risk for the potential of making 500. That's not me saying that. That's what the math says in that current moment of the actual trade. So your $400 you started with really means nothing. What matters is what you have now. And here's a good example. So if the trade bounces, it flips again. Okay, now you made $80 on the trade because it started going up. Now your trade is worth 260. So on day 5, you have 260 and 240. Okay, on day 6, maybe you get about $20 more. Now it's 280 versus 220. Day 7, you get a big gap up. You make 130. Now you have 410 again and 90. So you're kind of back to closer to the original. Then it goes up more. Now you're risking 450 to make the remaining 50 on the trade, right? And by the way, here's the cool part. Let's say the trade starts moving exactly like this and you're starting to make money on the trade. What happens if it starts going sideways? Why am I still making money? Before, if it went down, I was losing money and I was making money only on big green candles. Here I'm showing you the stock went nowhere and I'm still making money on the trade because time decay is now kicking in, right? We're getting closer to this expiration and now time decay is kicking in for me and I'm making money even on sideways days. So this is really important, guys. This is super critical. I don't want to go too far into the weeds and melt anyone's brains, but this is nuanced and trading is nuanced. Now that time decay is kicking in, it answers the question, why would I risk 460 to make 40? Why would I do that? Shouldn't I just close out the trade? Well, the answer is maybe, but also once you get into this position, so many scenarios continue making you money that even though it's your risk reward has switched to ugly, it still is helping you because so many scenarios are making you money that yes, your risk reward is turned negative, but relative to the fact that you probably have a 95% chance to stay above and everything's adding value, it makes sense to risk the 460 to make the remaining 40. And then, of course, if it expires here, it exercises for a full profit. And when that happens, you now, even though here you only had $180 left on the trade, right? If you closed out, that's what you were getting. And that's what your risk was. Guys, your risk can only be what you can get out of the trade in that moment. So if you close at this red bar, you were getting $180, and now you're exercising and you're getting $500. So $500 relative to the 180, because that's all the value you had on the trade, is a pretty darn good risk reward to keep that trade open. All right. So that understanding your original trade doesn't matter as soon as you click the button. It matters what your real-time risk reward and your probabilities and how they fluctuate. So the obvious question then becomes, Nate, are you saying you're willing to lose 100% when you're wrong? Bob, no, not to get the original 100. Bob, that's wrong. Not to get the original 100. I don't want to beat you over the head, but it's really important to understand this. If you close out the trade here, you are not getting the original 100. If you were minus 180 in terms of the value, sorry, if you had $180 left on the value of the trade and you get 500, you legitimately made 320 bucks. Okay? So I don't want to beat you up. I'm not trying to be obnoxious. I'm just saying you have to understand this in made $320. Okay? Oh, I think I froze there. Am I unfrozen? Okay, sorry. Okay, I'm being obnoxious here. I just want to beat this horse because it's super important. Okay, if the trade was worth $180 left, let's say that your account is $1,000. Okay, your account's $1,000. You started, you put a $400 trade on. It went down 220, and you closed out the trade. What is your account at? It's at 780 bucks, right? And if you close on this candle, your account is 780. Well, you have to compare that in real terms. 780 is what you legitimately would have been at versus if you kept it open, it closes here, you're at a different number. You're at 1100. Okay? So you can't compare 1100 to 1000. That's not real. What's real is that your account was worth 780 at this moment. So you didn't make a, theoretical $100 from here. You made a real $320 from here to here. Not again, you didn't make back your original 100. You made a real $320 from this moment where your account was at 780 from this moment to when your account was at 1100. Okay, does that make sense? Great question. So someone said, so stay until expiration no matter what. Not so fast. Not so fast. I'll explain why. But hopefully that part makes sense. Remember, this lesson is not why not to use limit, why not to use target. It's why not to use stop losses. Okay, so then the next question is, Nate, are you saying you're willing to lose 100% if you're wrong? And the answer is, heck yes, I am willing to lose 100% if I'm wrong. For me, that's actually one of the best parts about trading this way because I can use this structure to have defined risk and max out the time potential for a trade to be positive or hit my target. So either expire or just hit my target. It doesn't mean that I'm waiting for expiration. It might just mean that I'm waiting for it to hit my target. Either way, no stop loss means I am giving that trade the max amount of time. So think about it like this. Hopefully this will give you a light bulb moment. Most stocks don't move in a straight line, right? So they look something like this. Hopefully everyone would agree that most stocks look something like this. They don't move in a straight line. A stop loss is like saying, I want to lose money anywhere in this zone. Anytime that a trade drops down into that zone, cost me money, take me out, right? A limit with no stop is like saying, I want to make money anywhere in this zone, right? So to me, a stop loss is like saying, hey, even though I know the market doesn't move straight up, it's probably going to bounce all around. Anytime it hits this level, get me out, take my money. To me, a limit with no stop loss is like saying, listen, give me as much time as possible, and anytime it hits that level anywhere in the zone, take me out. And for the average trader, I can't think of a bigger advantage than simply giving yourself more ways to win and less ways to lose. Jeff, absolutely. Jeff, you're exactly right. At the end of the day, you have to have a higher win rate if you're trading for a 20% win, for example, in this example. However, the same holds true on something like this, Jeff. If you enter here and you have a limit up here for, let's say, I don't know, a 75 to 80% ROI, which would probably be about what it would be if you entered at the strikes. I mean, Graham uses wrap orders. Your max potential is 100%, but if you put a target up here, your potential might be 75, 80%, where down here, your potential loss might be 50%. The math is still going to work exactly the same way, Jeff. You will have more opportunities to win and claim that 80% versus way more opportunities to lose and claim that negative 50%. So same concept, and you can adjust the risk reward and widen out that potential as much as you want, but the concept is still going to be the same. So you now will lose more on those losses if you go with my strategy, where you just say, listen, I'm going to give it the max amount of time, but you will have a much, much higher win rate. And so at some point, the win rate overcomes the average loss. Now, let me give you an example of this. So let me give you an example of this exact situation. So for one of our strategies, the overnight income project, my original testing was to go for something like plus 50% wins. Guys, these numbers, by the way, won't be exactly right because I don't remember the exact numbers, but they're pretty close. It was something like go for 50% wins and 50% losses. Okay, so cap my losses, cap my wins on the overnight strategy because I know the market moves overnight positive. And the win rate was like 51%. So it was literally like break even across the board. By the time you accounted for fees, you were basically losing money. Because what happened is the market did move up more often than it moved down, right? But because the market does exactly what we just talked about in this example, it moves up and down. Well, what happened was it took me out of the trade a whole bunch. So then I tried, okay, 50% with 100%, and it got a little bit better. But guess what? It didn't move up enough as often. The average move overnight was only like 0.2%. So it didn't move up. So I kept going more extreme and more extreme and more extreme. By the time I got to this really ugly risk reward of like plus 18% and minus basically like 95%, because the only ones that you take out a loss is when you get either in between expirations or you let it expire as a full loss. Starting out, I'm pretty sure everyone would have said this is a better strategy. Win 50 and lose 50. I'm pretty sure everyone would have said that. In fact, that's what I leaned toward and started. By the time we got to here and we realized that we could win 88% of the time in these numbers, we realized, holy smokes, by the time you do the numbers, this is such a better profit factor and annualized return that you can multiply over and over again. Even though the 18 versus 95% looks ugly, it makes way more money because the scenario is so far. Because in fact, basically what the scenario is it's like this. You know what I mean? Like basically we're saying by expiration, As long as you give it something like this, your risk reward is basically like that. So because the market tends to move up overnight, and even when it's not, it tends to at least be stable, your risk reward becomes something like this. Does this make sense? Are you guys catching a little bit of the light bulb moment that I was hoping to get across today, where it's all about scenarios? Risk to reward, I'm just going to be honest with you. Risk to reward is one of the biggest scams you'll ever hear. I'm just going to say it. Sue me if you want. It means nothing on its own. It sounds cute to say you should always trade with a positive risk to reward. In reality, it means absolutely nothing on its own. There's great positive risk to reward strategies, and there's many, many, many horrible risk to reward strategies. As a matter of fact, I always share this because I think it's one of the most mind-blowing things ever. Let's go look at a stock like Apple. Everyone agree that Apple's been a pretty darn good stock the last few decades? I mean, you guys can give me a no in the chat if you think this isn't a pretty darn good looking chart. Here's Apple, up thousands and thousands and thousands of percent. Pretty good stock over time. You can actually cut off recent momentum and just stop here and run this test. I bet you guys, including me, a year ago, would have all said, look at this chart. What a phenomenal chart. If you wanted to trade intraday as a stock trader and you wanted to trade it with a 10%, we're talking about the underlying stock, not options, a 10% target, okay, and a 2% stop loss. I'm assuming everyone in here would think that's a phenomenally good strategy because with the benefit of hindsight, you can see Apple goes up 10% all the time. Guys, would it absolutely shock you to know that even on a stock like Apple, where you know the reality, a 2% target and a 10% stop loss is a far more profitable strategy? Would that shock you to know? Because for me, I almost had a heart attack on site when I found that out. Even a stock like Apple that's moved up thousands of percent, that has big moves all the time, is more profitable over time, just literally backtesting real time with a 2% target and a 10% stop loss than it is at a 10% target and a 2% stop loss. Why is that? Well, it's because even though Apple moves up, and it even moves up 10% a lot, it moves up 2% a whole freaking lot more. And every time it does it, you're recycling your profits, giving it room to the downside. Even if it moves 5% down, 2 weeks later, it's going to pop and hit that 2% target again. Then you're going to reset. Then you're going to reset. Then you're going to reset. And it just hits that target over and over and over again with lots of room. Whereas, believe it or not, this 2% stop loss gets tagged all the time, even with the 10% target. Even though 10% doesn't even seem like that much for Apple, it still nails that stop loss over and over and over again. So for me, I'm not saying, by the way, you should always trade with a negative risk reward. That's not my point. Most of my strategies are negative risk reward because the numbers don't lie. So I love trading with a negative risk reward on most of my strategies, but the real key is not that. It's the probabilities versus the risk reward. And what you will find is that taking those small wins and letting the market do this and keeping those ranges in the positive territory are the best way to trade for most traders. So again, hopefully I'm going to type this in the chat or put this in the chat because hopefully it gives you an aha moment today. I really believe this. I think the biggest advantage you can get as a retail trader, as an average trader, is simply giving yourself more ways to win and less ways to lose. I think if that's all you do, you'll have a lot more success in the stock market. And yes, for all of you guys, this will be recorded. You can go back through it. We'll put it on YouTube. If you're Opening Playbook VIP, it'll be in there. The deck itself, so you can go through the visuals, will be in the Opening Playbook VIP session as well. But again, hopefully this gives you kind of a clear idea of how to do that. So if you like this idea and you think, holy crap, that makes a lot of sense, well, then what I really want you to do next, shameless plug here, is pay very close attention to the overnight income project. Roger and I did a presentation on the overnight income project, 6 weeks ago or so, where in that presentation, I predicted the markets would hit all-time highs again this year, even though all the headlines were saying 2025 is going to be a recessionary year. I picked a couple stocks that were going to go up. They've been smashing it. But most importantly, I shared the meat and potatoes behind why this works and exactly what I just shared you. Why does an 18% average target and a big average loss still have the potential to stack up? Guys, it's because it gives you more ways to win, so many more ways to win, where you start creating risk rewards like this, and then you power in that overnight market phenomenon, which is why we call it the overnight income project. And when you combine those things, you get yourself what I think is the biggest, kind of daily ROI advantage that you'll get. So in this case, Rosalia, we're not giving ourselves as much time for the market to expire above the level. We're giving it as much time as possible to simply hit the target. We're making it even easier to get a win. We're making it even easier to get a win and even harder to get a loss. So, Deanna, if you don't mind queuing that up, what I want to do is I want to share this presentation. Again, this is about 6 weeks, maybe 8 weeks, going back, where Roger and I